Hey guys, wanted to share this with you, and I was talking to somebody about this, and he was like, "Dude, how are you always talk about these infinite returns, 275%, 300% returns? Like, how are you doing this?" So I was sharing it with him, and I was showing him, and I wanted to show you guys basically the strategy that I use for Bell Capital. I'm just repeating what already works for me, right? So I'm going to kind of talk to you. I wanted to share with you guys on a deal that I did. It's a smaller deal. It was a deal I did in Hawaii. The address was 103 Mango Street in Waihawa. You can look it up. Where's my pen? Oh, like I said, that's the beautiful part about real estate. Anything I talk about, you can always look up the address. Some of the bigger stuff we're underwriting right now, and we have under review for real estate here in San Diego. Can't give you the address because I'm under CA on that, meaning the confidentiality agreement, because they're under review. If I show anything, typically it's traded. We lost the deal, we didn't get it, but it's still on our deal sheet. I'll chase the deal down for a couple of years. So that's the difference. But this deal, I was telling him, I was like, okay, here's the strategy. I do it over and over again. I just do what works. I'm a very simple guy. So stick with me on the numbers, and I'll go through a bigger deal later, but let's just go over Mango. So Mango was a 10 unit deal. We picked it up for $1 million. And anyone can do this, by the way. This is real estate, this is multifamily. If you are in this business and you understand real estate investing, then you'll get this. But I'm going to run through the deal so you get it. So we picked this deal up for $1 million in Hawaii. It was a 10 unit apartment building deal. And I'm just sharing with you the strategy, how I come up with this. So the numbers, this could be 100 million, it could be 1 million, it could be 10 million. It doesn't matter, right? So just think with this. This is me telling them. So in this deal, we got a bank loan for 750,000. Boom. And we put down $250,000 of equity. This was equity, this was debt. So I actually raised all the money from a partner on this deal. We were in another deal, and he also invested in this deal as a partner. I actually structured, it was called Bell Investment Group at the time, and I was putting together my very first syndication. And then I met him. We were gonna syndicate the deal, and he was like, "I'll just do all the money myself, and I'll raise the money." So he put money in on the first deal. This was our second deal that we had did together. So a little bit of backstory. So on this deal, though, this is what I want you guys to focus on: the $250,000. We got a bank loan for 750, and then we did $250,000 as a down payment. That deal paid us roughly about 5% a year, right? We held that deal. So in the first 3 years, we made 15% on our money on the 250, right? So I was the person that found the deal, managed the deal, got the deal funded with the bank, brought in all the people. I built a property management team so we can self-manage the property. Yeah, that's what we did for all of them. So I wore all the hats. I got somebody on the team for administration. I hired people for our maintenance. I hired people for contract services. I did all of it, right? So I understood the operations, and we paid ourselves a management fee, a property management fee, because I put the team together outside of that because it wasn't a fund. This is just a 50-50 partnership. So we got 5% on our money in the first 3 years. This is a 3 year time. Now, during that time, I was raising the rents. So that's why this started to happen. Then at some point, I went back to the bank over the first 3 years, and we refinanced out the full $250,000. That went back to my partner, right? So that was an infinite return for him because we had no more money in the deal. Right now, we brought the debt up to $1 million, but the property appraised for, I think at that time it appraised for 1.5, somewhere around, it was somewhere around 1.6 because it was like 1.5 plus, right? So 1.58 or something ridiculous like that. So this is what happened. So now we have the debt here, but we really were at an infinite return. I'm going somewhere with this so you guys get why I do what I do. So I gave my investors their money back. So hear me out on this one. So that 250, right? Our initial investment, we made 5% on that times 3 years. That's 15% return just in cash flow alone on that deal. Then in year three, he got his 250 back as a partner. And then we kept that deal for another, I think it was like another, just at the end of the 7 years, we got another loan. And then we sold the deal for 1.7 million. So we made another 700,000 over the top of that. And while we waited, we got another, I think it was like another 6% on, it's called, like, it's really on equity. So 6% on the equity. So Because we didn't have any more money in the deal, naturally, that was just the equity that hadn't been cashed out. So we made another 6% on our money just by doing that, which was another roughly about $4,000 or so, or $48,000 a year. I know it's more than that because this is like 7 and 2 is 42, but it was roughly around $48,000 a year for another 7 years while we sat and waited. And then when we sold the property, we made another 1.7 million. And you can look that up online. You can go there and see that when that property 103 Mango Street in Waiha was sold, we bought it for $1 million. That's the first sale. And then later you'll see that we came to market and years later and we sold the property for 1.7 million. So this is what happens in the middle of that. So if you take a look at that, we got 700,000, right? Plus another, what's my calculator? We got, let's just say it was 48 48,000 times 7, another 336K in just cash flow, right? Now, and if we were to count the 250 that he got back, because you should, plus that, so that's what 700 plus 250 plus 336. That's 1.28 million. And if you want to divide that by the 250 that he actually put in at 1.2. So let's just go 250. It's really a 500% return on our money. 500%. That's how I run that. So in my brain, so here's what happens, guys. When I look at any deal, I'm always like, okay, if we were to get into this deal, and we'll use this one. So we put in 250, right? We made the 5% on our money. Then we got our 250 out, right? So we had zero money. Now, and remember, this was non-taxable event right there because right that was a return of capital. So we got that money back. He got that money back. There was no tax on that. And then later we kept getting cash flow for another 7 years. And remember, we got cash flow for 3 years here. We got cash flow for these three. So we got 3 years, 7 years. That's 10 years of cash flow, right? While we sat and waited, and then Pac picked up another $700,000 that we split 50-50, right? Because there was no more money in the deal. So technically it was an infinite deal, but really this deal turned out to be more of a 500% return. I like to say it was an infinite return or a 300% return just because the math just goes all over the place. I can add it all up and carve it up as I need to. But if you're an investor and you're wondering like, hey, what was the strategy here? When I break that down, it's like, hey, we put a down payment down. We go through with a plan to go ahead and raise the rents on the deal, right? Raise the rents every year that we're able to do that. Take care of the property, take care of the residents and the tenants, make sure that we do a good job. Now, on that deal, we self-managed. But on the deals that we look at now, we have a professional management company managing the deal. Then, as we raise the rents, we go back to the lender. This is the best case scenario. Go back to the lender, refinance, and take out all of or the majority of our initial investment, give it back to our investors. That's the goal, right? And then keep the investors in the deal for the remaining time to be able to hold the property and then hopes to go back and either sell the property or better yet, and this is what we should have did was gone back and refinance that property again, take out 700,000, give it back to my investor again, and then we still keep the property for cash flow and just keep doing it, recycling it over and over and over again, right? And then what do we do with the 250? We reinvested it into another deal, right? And then we would have been reinvesting it into another deal here too, but we actually exited the partnership because we had been in that deal for like 10 years plus and I was ready to move on as the operator and the sponsor of that deal. So, this is how this works. Now, it works the same when I'm looking at any deal. So I just looked at a pretty big deal here. This deal, let's see. Can't really, well, I guess I can kind of show a little bit. I'll just show you the deal. Hopefully the brokers don't don't see it. Don't see the deal that I'm talking about it, but I just want to kind of express something and I'll make a couple of changes. Let's see. Uh, hmm, bear with me, y'all. It's important though, because again, I like to show you guys what I'm doing and why I'm doing it. Um, yeah, there we go. Here we go. All right, so let's look at the bottom of this thing. Anyways, we're just gonna do this. So like specifically like this deal. Can you see that? Beautiful location, beautiful property. I mean, it's Mac Daddy. On this specific deal, let's just say, pretend with me on this deal, and I know the numbers, but I'm kind of pulling it off because again, it's under CA. So let's just say we can pick this deal up for 100 million, right? So this deal right now, I believe this deal, if we were to do this deal, let's say we put 40% down, we'll put down 40 million on this deal because I ran the numbers, right? I think this deal we did 5% on our money. So let's just say we all came together. Let's just say 10 of us, 40 of us put in $1 million each. Um, whatever, however you want to carve it up. All of us got together and we all put together $40 million for the down payment. We got debt for the 60%, and this deal makes sense because I think we're going to make 5% on our money. So that would mean that every year we get $2 million, keep it small, on our money, just in cash flow on this specific deal, right? So over 10 years, we would have $20 million. I'll just do that. We would have made $20 million of our initial investment back on that specific deal, on this deal. This is how I underwrite a deal. This is how I look at all deals, period. If I can make something like this work, I'm more interested as an investment. So let's just say we did that. We all came together. We put down $40 million on the deal. We bought it. We're getting 5% a year on our money. That's $2 million going out as cash flow to our investors, to all of you guys, all of us together. We all get a little bit. Then in over 10 years, we would have made half of our money back. That's a 50% return, again, on our money just in cash flow. Now, we can't expect that over 10 years, this deal, that specific deal, and I'm going to show you the deal again, we couldn't expect that over 10 years. Do you guys think that just looking at this deal, just looking at that deal, that this deal, 300 units, a a location, irreplaceable location, best in class asset would not be more, let's say this property would the rent in this property would be like 5% higher, right? That right now the average in-place rent on all the different units is roughly 29, I think it was like 2909, right? On this specific deal. Like look at this property. You tell me if you think a property like this, I'm trying to get it in somewhat focus. A property like this, that property, 300 units, best in class, A class property, new asset, would not be at least 5% more in rent than it is today. And if you look at New York, a two-bedroom rent in New York, Manhattan is probably 5,000 or 10,000 a month. You go all the way to Silicon Valley, and it's probably about $10,000 a month for a two-bedroom 1960s property in the middle of like nobody want, but everybody will bitch about that price, but everybody will pay it. So let's just say this one, we get another 5% increase. And there's a reason why I'm talking about that. So another 5%, that's another $2 million increase over this, another 5% because we didn't change this. This is an increase. And let's just say we only got this for 5 of the 10 years, 5 years only, right? So that's another $10 million that we made just in cash flow, right? That's $30 million just in our cash flow by itself. Almost 70, that's 75% on our money that we've made just sitting and waiting for the value of this property to go up. And it went up because of this. So and then later, when I'm looking at that deal, my goal, our goal for our investors or any deal, this is the same thing I did with 103 Mango Street, the 10 unit, $1 million deal. And I'm looking at a $100 million deal with the same strategy. So you guys get it. Because this is what you guys are going to do for your investors as well. Is you're going to be like, okay, fine. So my goal is if we, let's say we were to sell this property, we come to market, we did all of our work, we come back later, we still have our $40 million, remember, because that don't go away. That's called CP, capital preservation. We preserved our capital by taking our hard-earned money, by all of us as a group, whether it was 100 of us that did 4 million or whatever the math is for that 100,000, however we did the thing, or and then all we did was put together our money, go here. Now our money's sitting is we converted fiat cash that's going down in value every day, and we moved it over to glass, steel, bricks, brand new property, operating business on the top of it. people paying every month, like clockwork, on contract that can't afford it, and our money is safe there, right? It's like taking it out of the bank, putting it here. So now, if we were to sell it, this is strategy number one. If we were to sell it, which I wouldn't, I would always go back to the lender. I wouldn't want to sell it unless I got our one, we got our money back, our initial investment back first, right? Preserve capital, don't lose money. And then two, I wouldn't sell it unless we made another 40 million plus. Period. It would make 0 cents to sell unless we made our 40 million back plus another 40 million. That's the 2x. That's the double. You hear me talk about doubling your money. That's a double. You put in 40 million, you get back 80. Like that's how this works. But in this situation, I'd be like, okay, I wouldn't sell. So if we do our math, we got what on this page? We got 30 million, 30 million in cash flow over 10 years. So we would have gotten what is that? 110 million. We would have made 110 million on that deal. Boom, and I'm gonna go over my two. $110 million just sitting and waiting. That's a 275% return on our money, right? That's the number one thing. That's if we were to sell it. Now, let's say we didn't sell it. Well, let's say we went back to the lender. And in this specific deal, let's say we can refinance our money out. So we're gonna take that, we're gonna go back to the lender. I go back and they go, yeah, Vic, sure, we'll do it. We'll refinance the property. We'll give you your 40 million back. This goes back to my investors. All of us take our money, right? That's an infinite return now because there's no calculator that can calculate the return on your money if you've put in money, I've given you your money back, and you still own the asset. It's still cash flowing every month, and we're still going from there. Now, well, I mean, people don't like to say this, but will your cash flow go down a little bit? Yeah, absolutely. But you got your $40 million back. And this is a non-taxable event, right? So you don't get taxed on the money that I give you back. And you still own the asset, and you still got cash flow coming in every month. You got cash flow. And remember, your money, because you still have equity in the deal, because we haven't sold it yet. We're refinancing in this scenario on a refi. On a refi, I call it a refi cash out. On the refi cash out. So we still have cash flow coming in and our equity is still preserved. We still have money in the deal. Didn't go away. And we still own the asset. So we still get the tax benefits, the write-offs, which I didn't go over, the depreciation and all the other stuff that I went over in the example for Mango. We still had all that stuff, all the write-offs. Most of the cash flow was, we didn't get taxed on that money because it came from the real estate, right? So this is all, so you're getting cash flow, you got capital appreciation now, you got your tax benefits, right? And you had, I got it right there. You have an infinite return. You have an infinite return on your money. And now you're just sitting and waiting. This is how the wealthy multiply money, right? They don't go and they don't sell assets. They actually go and they multiply by doing what? Protecting their capital, making sure that if they're going to exit a deal, they're either going to double their money over a period of time or they're going to refinance and go back and say, hey, look, and they do a full calculation. Hey, this is all my cash flow. This is the equity that has been built up in the property. I've doubled my money that was in there. And for us, just like I did on Mango, I went to the bank and I'm in this deal. I'd go back and like Fannie, Freddie, life insurance company, a debt fund, and I would be able to substantiate my numbers of increased income value by raising the rent and the income and managing the property right, and be able to substantiate it by saying, here's the new increased value based on that rental income increase and what we want to do. And will you go ahead and let us do it's called a recapitalization is what it's called. And that'll be based on the income of the property. They use what's called like the DSCR to be able to decide whether that property can afford it, or they'll use what's called the debt yield, which is just, and I'm sorry, I'm getting out of place. That's a little bit more confusing or a little bit more advanced, but I go over that in our training. So if you're interested in our training, leave me a comment, or you can go to bell-capital.com/free training. We do a free webinar and I go over exactly more details about this and how you can do it too. But this is exactly what we did. This is what we did on Mango. I bought the property, refinanced it, gave my investors their money back, and gave my investors, my partner, his money back. It was an infinite return for him. Then we kept the deal and then later sold that property for triple what we had in it, even though we had zero money in the deal, which turned out to be a 500% return, in that situation, because I'm including the cash flow and I didn't include depreciation, all that other stuff. All that stuff's in there. And on this other example is a deal that we're looking at now. We're just underwriting the deal. It's probably not going to be a deal we're going to do. I love the deal, love the location, but there's some other stuff going on over there. And again, that's why you got to know this business. So aside from investing your money, like how do you get these returns? You also have to know that the deal can produce the returns that you're looking at. And I'll be honest with you, if you're a dentist, you're a chiropractor, you're a plumber, you own an HVAC, HVAC company, and you're busy running your business and growing it and trying to scale it, dealing with employees and customers and marketing and sales and administration and growing and delivering a service, you don't have time for this. You just want to run your business like a normal person. You got enough headaches and run your family, and you just want to put your money to work harder than you could work for it. Like, even on my example of the $40 million, let's say we like again, let's say we had the 400 people all come together and do $100,000, right? If we were to turn that property and double that money, you couldn't work hard enough to double that money in your own business because there's risk. In this situation, this is a 300 that deal, 300 unit apartment building, great location, already operating, has been operating, professional management company, professional contract team, a person that knows what they're doing. It can support the debt, professional brokers. There's some super smart people on this deal. I'm not a super smart guy, but I'm very super smart as it relates to common sense and what makes sense. And this makes sense to me. So, but if we were to all come together on that deal, you couldn't replicate that and spend the time to keep your eye on the ball, right? Like I tell people, keep the main thing, and focus on making money for your in your business, to taking care of your family, and then put your money to work as hard as you work for it in an income producing real estate deal that's big enough, that has the scale enough, like a deal like that, to make the deal work. Now, you want to do a deal like Mango, like I did? Yeah, by all means, go ahead. That was a lot of work. That was 10 years worth of work. And I didn't just have that one property. We had a 12 unit building down the street. We had a 17 unit building. We had a bunch of other multifamilies around Hawaii, on Oahu, and I also had a bunch of single family houses because I was churning and burning. Like I had another partner, and I was like, "Hey, let's get this deal. Let's do this deal. Let's do that." But I don't do single family flips and fixer uppers. I do nice, pretty houses, is what I call them. When I was doing that, right now we turn all of our energy into saying, "Hey, look, what is the thing that can help me build a multi-billion-dollar real estate company where I can help more investors like my last partner?" Because imagine, had you been my partner and you put in 250 in a deal, you got your money back, and then you tripled that money, and you got cash flow and all that other stuff, how different would your world have been? Seriously, just think about that. And you can't do that if you're trying to, I mean, he who chases two rabbits catches neither. Period. He knew that. He just invested, let me get onto the work, and I'm doing this for with Bell Capital, and I want to do it with more people like you. So again, how do you double or triple your money? How do you get a 300% return or an infinite return? That deal was really a 500% return, but nobody's going to click that button. It seems like a scam. But I wanted to share with you what I did, how I did it, and how I look at how I make sense of some of the deals I look at now too. So if you need anything, let me know. I'm here for you. If you want to get involved in us, go to bell-capital.com. There's two things you can do there. You can schedule a call and we can help you, or you can hit get started or invest now, and it'll take you to the portal. You can see our open fund, how it works. You can do your own due diligence on our paperwork, our fees, what's available right now. And if you have any questions, we're here to help you out. So the two things you have to be accredited. Well, three things: you got to be serious, and you got to have a great attitude. We don't want troublemakers, problem people, people who are always in trouble, losing money, getting into accidents, complainers, belly aches, whiners, somebody who needs to be handheld. This is for people who are serious about investing in real estate. Most of our people, they have the money, they just don't have the time. They don't. They don't want to do it either. They don't want to learn. They don't want to read books. They don't even really want to watch these videos. They're like, dude, I have some money. How do I invest with you? What does it take to get started? What do the deals look like? How's it work? Stuff like that. Like those are the best people for me, and I'm sure that's probably you if you're watching. So that's how you get going with us. Go to bell-capital.com. But for now, I hope this video helped you guys. Like this video, share the video, comment on the video. This is what I shared with my buddy the other day, and we were talking about it. He was like, dude, you talk about infinite returns, 300%, 200% returns. How does that even work? That's how it works. It's a replica. I just do the same thing over and over and over again. Find a great deal, great location that's cash flowing up front. Put a good down payment down, get a bank loan, get great interest, get great rates on that on the debt. Make sure you can't lose the property. Raise the rents, refinance our capital out, repay my investors, recapitalize my investors. Then we float the deal. And then later we either come back to market and resell it or refinance it again. And we hold on to that property until it's the right time. With Bell Capital, my goal is to build a over the next 5 years or so, build $1 billion portfolio, and then over the future, a $50 billion portfolio, and take that to either Wall Street, turn it into a REIT, do whatever with that property, and then sell that property, and then all of our investors score one against Wall Street because I want to help the little guy instead of using institutional banks to be my investment partners. So, yeah, that's what we're doing over here. I would love to have you being a part of what we're doing. I know I go through this fast, but I wanted to do this because we got to step out and finally get over to the office. But today was a studio day, and I wanted to share some light on how you can get a 300% return on your money, how we do it, and how I can help you do it as well. So let me know if you need anything. Like this video, share the video, comment on the video, dude. I want to hear from you. Even if it's bad, man, I'll take that too. Let's go. I'm here. All right. So let's do it. Have a great day today. Let's get after it. Boom.